So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. In this video, Raoul Pal will talk about crypto, lead trends, and Bitcoin. Let's catch him up now.
Look, from our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID. Exactly the same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity or economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now, where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. All the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job. It's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only 2 assets that outperform this. One is tech stocks, and the other is crypto.
Robert Kiyosaki, the renowned author of Rich Dad Poor Dad, is once again making headlines with his bold stance on Bitcoin. As the world's first cryptocurrency surges past the $122,000 mark, a new all-time high, Kiyosaki has doubled down on his belief that Bitcoin is heading toward $1 million per coin. Celebrating this price milestone, he labeled it great news for those who already hold BTC. For others who have hesitated to invest, he called it bad news, stressing that owning no Bitcoin could be a missed opportunity of historic proportions. Still, Kiyosaki offered hope to latecomers. He advised those without any Bitcoin to start very small, starting with a Satoshi, referring to the smallest unit of Bitcoin. Demonstrating his own confidence, he revealed he is personally buying more, adding one more coin to his portfolio amid what he describes as growing economic chaos. He emphasized that he will continue buying until he better understands where the global economy is heading. Kiyosaki reiterated his forecast that Bitcoin would reach $200,000 in the near term and eventually soar to $1 million by 2035. He also pointed to Warren Buffett, who recently sold his stock holdings and is holding $350 billion in cash. Kiyosaki hinted that even Buffett may eventually pivot and invest in Bitcoin.
And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julian, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really, to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics are destiny. They are. Until the AI and the robots come, which are basically artificial humans, this is the problem that faces us all. But there's a way that they've got round this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands, and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate.
Hype drives headlines in crypto, but the real breakthroughs are often buried in code commits, developer chats, and quiet updates that never go viral. If you want to spot hidden crypto gems before they moon or rug, you need more than chart patterns and influencer threads. You need a deeper lens, and GitHub, Discord, and X offer exactly that. GitHub gives you a raw look into the actual code being written. Frequent commits, multiple contributors, clear documentation, and active pull requests all signal a living, breathing project, not just a flashy white paper. For instance, Internet Computer, ICP, currently ranks number 1 in GitHub activity, with thousands of commits tracked from over 120 developers, showing serious ongoing development. If a project claims to launch in Q3, but its GitHub repo is quiet, that's a red flag. Discord, on the other hand, reveals the human side of the build. Real communities discuss bugs, debate proposals, and give direct feedback that often turns into commits. A project where developers show up, post enemas, and push regular changelogs speaks louder than a Discord flooded with WAN Lambo noise. Then there's X, the public square of crypto. Follow developers, not influencers. Watch what they're testing, fixing, or launching. Often before it's announced, combine all 3 platforms to move beyond hype, track innovation at its source, and make smarter, earlier crypto moves. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.